Top 10 Tips for 2015 Canadian Tax Return, Part 3 Feed. The Canada Revenue Agency CRA Rental Income Guide T4036 is a great starting point for any investor looking for plain English information on rental property taxation. While Canada Revenue Agency guides do not hold the same weight as actual tax law, they are based on legislation, case law and the Canada Revenue Agency internal policies. Foreign investments. If you owned foreign investments whose total cost exceeded $100,000 at any point in 2014, don't forget to file the newly updated Form T1135 Foreign Income Verification Statement when you prepare your tax return this season. Foreign property that's reportable will include the obvious things like money in a Florida bank account or an Arizona rental property, but also includes foreign stocks, like Apple or Google, which are held in your Canadian, non-registered brokerage account. It excludes foreign securities held in Canadian mutual funds or inside a registered account like an RRSP, RRIF, TFSA or RASP. The form is due on April 30th, the normal filing date for most taxpayers, but can be filed as late as June 15th if you or your spouse or partner were self-employed in 2014. Penalties for late filing Form T1135 are severe, $25 for each day beyond the deadline, up to a maximum of $2,500 plus interest. On the form, you are asked to report the types of foreign investments you owned in 2014 and their maximum cost amount during the year. You also must report their fair market value at the end of the year, along with the country in which those assets are located. Taxpayers are also asked about the income lost from those investments along with any gains or losses from the disposition of those assets in 2014. Consider paying dividends. Paying salary and bonus can result in the high tax bracket for business owners. Using dividends to pay the business owners can result in substantial tax savings. Creating a holding company. Risk of clients and creditors suing the corporation. Benefits of holding company. Creditor-proof excess funds of operating company. Enables income splitting and tax-free dividends from operating company. Holding company will have more pre-tax money to invest. Break on capital gains by donating to charities in Fed Budget 2015 feed. The federal government is going to make it a little easier to avoid taxes on real estate investment gains, as long as you give the money to charity. Federal Budget 2015 will let Canadian real estate investors donate proceeds from their real estate and be exempt from some capital gains tax which is charged on investment property. Principal residences are already exempt from the tax. To qualify, you have to sell your real estate to an arm's-length party, someone not related to you, and then donate the proceeds within 30 days. If a portion of the proceeds is donated, the exemption from capital gains tax is applied to that portion. The new measure, which would reduce federal revenue by about $265 million over the 2016-2017 to 2019-20 period, applies to donations related to properties sold after 2016. As an example, someone who bought a Canadian property for $300,000 and then sold it for $500,000 and donated $200,000 to charity would be exempt from capital gains tax on 40% of that $200,000. That person would be paying tax on $120,000, and since capital gains are taxed at a 50% rate, they would only pay tax on the $60,000 taxable portion. In the case of Canadian professional real estate investor who bought a Canadian property for $100,000 which appreciated to $500,000, they could donate that same $200,000 and get a break on $160,000 of capital gains. They would have a capital gain of $240,000, of which $120,000 would be taxable. Delaying of filing your tax return after deadline have severe penalties. Regardless of whether you owe the government a dime, filing late may also delay the payment of your quarterly GST or HST credit or child tax benefit. The deadline for individuals to file their income tax returns is a week away, on April 30th. For the self-employed, the deadline is June 15th. Missing that deadline for filing tax return triggers charges that start piling up on your tax bill right away. If you owe money for 2014, compound daily interest is charged starting May 1st. But you'll also face the late filing penalty of 5% of the amount owing, plus 1% of the balance owing for each full month your return is late to a maximum of 12 months. That amount can bloat even further if you were charged a late filing penalty for 2011, 2012, or 2013. If that's the case, your late filing penalty for 2014 may be 10%, plus 2% of your 2014 balance owing for each full month your return is late, to a maximum of 20 months. As well, you need to file a timely tax return to apply for the quarterly GST or HST credit, or if you or your spouse or partner want to receive the child tax benefit. The CRA encourages Canadians to use its quick, easy, and secure electronic services to file their income tax and benefit returns on time and pay any amounts owing. Even if you are missing information, tax professionals say you should file your return on time anyway to avoid the penalties. You can file the changes later, once you get the information, when you receive your notice of assessment from the CRA. You are also able to request changes to tax returns for the previous 10 years if you realize you failed to claim deductions you were entitled to.